The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone, and welcome to our presentation on certain crucial financial statements in Design Manager. My name is Brad, and I'll be hosting the demonstration today. If you have questions during the webinar, feel free to enter them into the questions pane on your GoToWebinar panel. If the question is outside of the scope of today's discussion, please email them to support@designmanager.com. And lastly, if you miss a portion of the webinar or want to review any of our past discussions, go to our YouTube channel at Design Manager Inc., Design Manager Inc. And here you can see any of our quick start discussions, tutorials, project management and accounting courses, and of course all of our weekly webinars as well. Now, today we'll be discussing two of the fundamental accounting reports necessary to properly gauge the fiscal health of your company and which are most commonly requested by your accounting professional or needed by yourself to properly file your year-end taxes. And they are the balance sheet and the income statement. And we'll also discuss associated documents known as the trial balance and the cash flow statement towards the end of the webinar. Today's discussion will be a bit more theoretical as compared to most of our webinars where we focus on very practical processes in Design Manager. But understanding your income statement and balance sheet is critical to be able to monitor your company's profitability and overall financial worth. As the reports are nearly identical in both Design Manager Cloud and Professional Cloud, I'll be demonstrating predominantly in the Professional Cloud to minimize the distraction of switching between the two platforms. Okay, so we should begin our discussion with the accounting model Design Manager utilizes so we can better understand how activity is captured on the balance sheet and the income statement. Design Manager utilizes the accrual accounting method, whereby sales to the client and purchases from the vendor are realized upon the creation of the client invoice and the recording of the vendor invoice, respectively. The concept of the invoice as the transfer of ownership of the goods and services through the design process fundamentally powers the accrual accounting engine. Conversely, in cash-based accounting, the sales recorded when the client pays you, or your purchases are recorded when you send payment to the vendor. Now, there are many drawbacks to cash-based accounting, most importantly being dramatic fluctuations in net income, which results in poor forecasting, handling of and accessibility to credit, etc. Net income fluctuates greatly in the cash-based model as your company will have huge purchases or increases in cost of goods sold as it buys merchandise and services for a project in the initial months, resulting in a negative income. Then a massive flip of income occurs when the client begins paying as all the revenue is being realized much later. Now, in accrual accounting, the cost of the purchases from the vendor and the revenue being realized upon selling to the client are synchronized to the point that the client is invoiced. This is why the accrual model is the method used in generally accepted accounting principles, or GAAP, as you may have heard, for interior designers. And all of this activity can be monitored with the balance sheet and the income statement. So how do we view these two documents? Well, in the Professional platform, you can jump on your Accounting tab and go right to the Financial Statements button, which essentially brings you to your Reports window under your General Ledger folder, then under the Financial Statements folder itself. And as you can see, I've even added those 4 different documents already to my Favorites menu simply by selecting it on the main tree on the left-hand side and clicking Add to Favorites. For our Design Manager users, very similar. Simply go to your Reports, go under General Ledger, Financial Statements, and there we can see balance sheet, cash flow, income statement, trial balance, etc. And again, I've added those to my Favorites tab on that window as well. So let's begin with the balance sheet. We're going to review the overall structure of the report and start to follow how activities in the natural design business cycle begin to appear on the report. The balance sheet is used primarily to display the overall financial health or worth of the company by analyzing the assets of the company against the liabilities and equity. But it can also be used to estimate cash flow by comparing accounts receivable to accounts payable and perhaps your credit card accounts. You could estimate future revenue by reviewing work in process and client deposits, among other uses. Now, there are three types of accounts that appear on the balance sheet. And let's look at our chart of accounts. To see which one they are. So on the balance sheet, we're going to be focusing on the first three sets of accounts on our chart of accounts. What do I mean by that? Well, in general, accepted nomenclature, our assets are generally in the 10,000 range. And these are areas of value to the company: checking accounts, savings accounts, inventory, those types of things. Next, in the 20,000 range, are going to be our liabilities. These are sources that withdraw value from the company: accounts payable, sales tax that you still have to reimburse, client deposits, those types of things are going to be considered liabilities. And lastly, the balance sheet will also have equity accounts, which are generally in the 30,000 range. And these are the accumulated, let's call it capital employed portion of the company, which represents essentially the net worth or the owner's portion of the assets of the company. Let's take a look at the balance sheet itself. So first, you could select the desired period for which you want to print your balance sheet. It's going to default to your current fiscal month. So in our case, it's going to be showing December of 2017, but all of the documents we're looking at today are fully retroactive. So I could go and print a balance sheet as of last year, or even many years into the past. I can optionally show the prior year's information for comparative purposes. I can show the timestamp. What does that mean? What it means is, as we'll see, on the document itself, Design Manager will automatically print the current date and actual time the report was written. So if I print a balance sheet for December of 2017 today, and then I go print the same report for the same period several months in the future, let's say April or general tax time, and I notice differences between the two, well, I know that somewhere on that report in those various accounts between the day that is timestamped on the original balance sheet versus the brand new one, those accounts have changed. So that timestamp does become an invaluable tool when you're tracking down what may have happened to various accounts over a time period. You can optionally suppress accounts that have a zero balance. That simply makes the report shorter in nature and also a bit more readable. And then we have available layouts. What are the layouts? Well, if I click the layout button on the balance sheet report window, I can see, there we go, I have the overall structure of how the report will be displayed. I'm going to show my assets first, followed by liabilities and equity. And those overall sections are fixed, but I do have the ability to alter some appearance of the balance sheet. For example, I might want to have my inventory and my work in process right beneath my cash, checking, and saving and undeposited funds accounts. And I can simply drag and drop them, right beneath those areas as such. I could also group accounts together. Perhaps I want to have all of my withholding accounts grouped and summated for me. To do so, I could add a new group. Let's call it withholding accounts. And then I could put all of the withholding accounts into that folder as well. And once I make my changes, I may want to name or reclassify this quote-unquote version of the balance sheet. So I can use the rename function. Let's call it perhaps, how about owner's view. And then upon exiting the balance sheet layout window, I can close my balance sheet report. And now notice my layout has our brand new owner's view available for us. And you can have up to 3 customized layouts as well. Okay, so let's take a look at our balance sheet. Let's make this a little bit larger for us. There we go. The top right corner, there's the timestamp indicating exactly when I physically printed this report. Again, that comes in surprisingly handy. And as we saw on our balance sheet layout, we're going to have our assets first, followed by our assets at the top, followed by our liabilities and equity accounts beneath. Let's review our asset accounts first. And many of these accounts dynamically affect one another, as we'll see shortly. And these are going to be accounts such as any checking or savings accounts that we may have. If we use undeposited funds, those may be included as well. We're also going to see accounts such as our inventory. This is an asset the company has purchased these goods. We're waiting to resell them at some point, but we exchange one asset, cash of some form, to purchase another one, inventory. Hand in hand with inventory is going to be work in process. These are the goods and services the company has purchased, and we have not yet invoiced to a particular client or clients. We technically own these goods until the point that we actually invoice them to the client. But at this point, they're maintained as an asset to the company. We have purchased them. I like to think of work in process almost as quote unquote earmarked inventory. I purchased it for a particular project, and I'm simply waiting to invoice the client for those goods in the future. We're also going to see vendor deposits. These are funds that we've provided to a vendor in order for an order to be fulfilled, 50% or what have you up front, so they begin processing the order for us. But technically, these funds are still ours until the vendor applies those funds to reduce the balance of a future vendor invoice. Accounts receivable. This is the unpaid portion of all of our client invoices. So we've invoiced the client, there's a balance due on there. So it's an asset because technically the client owes us or are in arrears for those funds. Equipment, of course. The value of any printers, computers, copiers, etc. That will be depreciated over time, of course, but that's an asset. It's a tangible value to the company. And savings accounts as well, as I said, along with cash checking, etc. What will be some other examples of asset accounts? A lot of fixed assets would appear here, and they're not as easily converted to cash, such as land or the building if your company owns it, motor vehicles, other furniture within the facility would all be considered assets or granting value to the company. Now let's consider the flip side of assets, which are our liabilities. These are, again, accounts that represent activities that are withdrawing value or worth to the company. So we'd have our accounts payable. These are going to be all the bills that we've entered but have not yet paid to our various vendors. So we've gotten the bill, entered them, and have yet to remit payment. So we still owe those funds. Sales tax collected. So we're collecting sales tax on the behalf of various tax authorities that we may be liable for, and we're required in no uncertain terms to eventually repay those funds. So we may tax our client on our client invoice, but those funds need to be obviously returned and remitted to the various tax authorities. So that's a liability. We owe those tax authorities those funds at some point in the future. Client deposits are actually a liability. Just like we discussed that a vendor deposit is an asset, the client provides us those funds, but the money still technically belongs to the client. We're simply holding it in good faith to be applied on future invoices. They could, in turn, at any time say, I want those funds back. So they're not technically ours yet, which is a very different concept compared to the cash-based model. American Express, any credit card account would be a liability. I'm using my credit cards to make purchases, but I'm simply borrowing those funds from American Express, Visa, MasterCard, or et cetera. And again, I'm expected to repay those funds at some point in time. Other liability accounts could be loans from officers or outside loans, loans outside of the company for capital. Those types of things that need to be repaid are going to be liabilities. Any lines of credit you may have from a banking institution, car loans, mortgages, those types of things are all liabilities. And finally, let's review our equity, perhaps the most esoteric of the various account types. And again, these are the sort of capitalized portions of the owner's worth. So we'd have common stock would be an equity account, retained earnings, current year income, other equities, maybe suspense accounts, and those types of things. So we can see that our total assets match the sum of our total liabilities and equity. Conceptually, the assets is the total value of the company. Now, if you take away the liabilities or areas that are reducing the company value, you're left with a portion of the company that is capitalized or owned, as it were, by the principals in various distributions of those equity accounts. And I find the balance sheet interesting because all the areas on this document interrelate and they flow perfectly through the design business cycle. What do I mean by that? Well, let's imagine that first we create a proposal for a client. And upon approval, the client would generally send a deposit or perhaps just a retainer. And these funds are recorded into the client deposit liability account. But it's also going to increase one of our cash accounts. So as we increase our liability, it's offset or balanced by an increase in one of our assets. Now, in accrual accounting, remember, this is not a sale. We're simply holding these funds for future use on the client's behalf. Now that we have that funding, we may need to send deposits to our various vendors for orders. And when we enter a vendor deposit, we're going to increase our vendor deposit asset account as we're sending out those funds, but we're either going to be then increasing our accounts payable, which would be reduced when we eventually send a check. So we're balancing off the vendor deposit by reducing our cash. Or if I put the vendor deposit on a credit card, I'd be increasing my American Express liability, but also increasing that vendor deposit asset. So you can see this natural, i.e. balance, if we think of the name of the document, then these checks and balances that are inherent on the balance sheet and through the design cycle. Further, now that the vendors are out there and they're fulfilling our order, in the near future, they're going to process the order, the goods or services, they're going to ship them, and when they're completed, they're going to send us a vendor invoice. When we record that vendor invoice, several accounts are simultaneously affected. First, we're going to alleviate any of that vendor deposit that may be applied to the vendor invoice. We're going to also increase our accounts payable as we're going to owe the balance of that vendor invoice. The cost that we incurred upon purchasing the goods, the value of the goods themselves, is going to go into our work in process account. So we're going to be increasing that asset. Now, once we pay the vendor, if we're paying by check, we would then reduce the accounts payable and reduce our checking. Again, if we paid the vendor invoice on a credit card, it would automatically balance on our liability until we ultimately pay the credit card vendor. So now it's time for us to invoice the client for our goods and services. And much like the vendor invoice, the client invoice affects a multitude of accounts. First, any deposit the client gave us for those goods would automatically be reduced and reduces the ultimate balance due or accounts receivable on the invoice. The cost that we incurred from the vendor invoice, which we were storing in our work in process, then gets transferred out of the work in process into the appropriate cost of goods sold account, which we'll see on our income statement in a few moments. So that asset that we were holding those goods is now moved to cost of goods sold. We're transferring the ownership of those goods via the client invoice. Any applicable sales tax would increase our sales tax liability account. And again, any remaining balance would be accumulated into our accounts receivable account. And then when the client pays us for that balance due, our accounts receivable account would go down, but one of our cash accounts would increase, basically reclassifying that asset. So all of these activities that occur within our design cycle process can really be monitored on the balance sheet by itself. Now, I often get asked, well, what about the profit of the sale? Where do I see this on the balance sheet? Well, the difference between the cost of the merchandise and services, of course, versus what we sold it for to the client is going to be accumulated in our current year income. So all of the profit that we make from invoicing the client for goods and services are going to be accumulated on the balance sheet in that current year income. And after the fiscal year closes, in other words, when we move from fiscal 2017 into 2018, all of the current year income is going to be cleared out or moved into retained earnings. Retained earnings is essentially the sum of all of the prior year's net incomes becomes moved into retained earnings. And upon clearing out, upon moving from one fiscal year to the next, not only do things like current year income become reset, but certain other accounts do, as well, as we'll see on the income statement. Now, before moving to that document, though, I want to point out one more aspect of the balance sheet. There are several extremely important accounts listed here, and we've touched upon many of them already. 5 in particular provide the foundation of the strength of the balance sheet, and they are the accounts receivable account, which we discussed, vendor deposits, work in process, along with our accounts payable and our client deposits. Each of these specialized accounts have their own specialized report, which we call subsidiary journals, to monitor the activity in them. And we can see them in 2 areas on our report window. Under accounts receivable, we have our aged accounts receivable report and our open client deposit. And if we print them, let's look at our aged accounts receivable. If we look at the balance of all of the outstanding invoices, we can see that it matches our accounts receivable account precisely. It provides the detail that's comprising that value that we see on the balance sheet. And the same for our client deposit report. We can see that our 15,650 matches precisely. And the other 3 reports are located under our accounts payable folder, such as our aged accounts payable, and we can see we have our 53,871, which is our current accounts payable on our balance sheet, and the same for our open vendor deposit, which has our 3690, which matches our asset on the balance sheet, and lastly, the work in process, which has a total work in process of 2495, and again, that matches what we see on our balance sheet precisely. So these reports, because they really represent pillars on our balance sheet, are what we consider at Design Manager our 5 monthly reports. As timely review of each of them is going to ensure that the account is correct. And if each of those 5 accounts is correct, the balance sheet has a very good chance of being correct as well. And you can view a full discussion on these reports in another webinar that we've had in the past called our 5 monthly reports to review, where I go into each of these in depth, because maintaining them, maintain the accuracy in all of those various accounts will make a very strong balance sheet. Very strong balance sheet indicates a very accurate worth of your company. Okay, now on to the balance sheet's partner in crime, the income statement. The income statement, also known as a profit and loss statement, measures the company's financial performance for the given month, quarter, or year by summarizing the sales or revenue, cost of goods sold, and expense accounts for both client-related and non-client-related activities. Just like our balance sheet, the income statement is going to be found under our financial statements, and notice it has its own folder because there are various versions of the income statement. And they are the monthly, quarterly, yearly, and comparative. And same for our Design Manager users. Under your general ledger, financial statements, and there are the 4 versions of the income statement, just like we have in our Pro Cloud platform. In brief, the monthly income statement shows the account balances for the selected month with year-to-date totals. The quarterly allows you to select a particular 3-month period or quarter within the year, and it's going to show the total for the quarter and the year-to-date. Yearly just shows the year-to-date values, as you'd imagine. And finally, the comparative. That allows you to enter a calendar date range and compare it against another. So you can monitor performance for quarter 1 of 2016 versus quarter 1 of 2017, or January of 2015 versus January of 2017, etc. Let's get to our yearly income statement for simplicity, and let's see some of our options here. First, the yearly is only going to provide us a fiscal year, while the monthly or quarterly, you would select a month, quarter, etc., as you would imagine. You have your various formats just by the year. I could select to show budgets. I could select to show the prior year in budgets, or a very similar comparative version. Now, budgets, for those of you who don't know, in the professional platform, your income statement accounts, which are the lower portion of our account glossary. Looking back at our chart of accounts, we know that our balance sheet has the assets, the liabilities, and the equity. So our income statements have the final 3 of our 6. In our 40,000 range, we have our revenue or sales accounts. In the 50,000 range, we have our cost of goods sold accounts. Particularly with cost of goods sold and revenue accounts, you'll often find, let's call them matching pairs, such as a 41,900 furniture revenue account and a 51,900 furniture cost of goods sold account. Very common nomenclature there. That way you can easily monitor how much profit or the difference between the revenue and the cost of goods sold that you may have for a particular genre or type of classifications. And finally, in our 60,000 range, we have all of our operating expenses or expenses. And these are generally non-project related expenditures necessary to run the business itself, though there could be certainly project related expenses in there as well. I do like to point out here one aspect of how a proper revenue and cost of goods sold accounts gets determined when you're invoicing a client and recording your invoices from your vendor. It's a fairly complex system in Design Manager, offering you a lot of sophistication and flexibility. And so be sure to review our sales categories discussion, where I go over all this information about sales categories, default accounts, etc., particularly pertaining to revenue and cost of goods sold accounts at length. But in short, when invoicing an item to a client or recording purchases upon from our vendors, first, we look at the sales category associated with an item. Sales categories are one of our glossaries. we can see our standard set here. And notice furniture, for example, has a series of revenue or sales and cost of goods sold associated with it. So our furniture sales category is tied to our furniture revenue and furniture cost of goods sold accounts. When you're entering your specifications, we can see on our item window, we can designate our sales category. So I know when I go to receive bills from vendors for this particular item, ultimately, I'm going to use the 51,900 furniture cost of goods sold account. On the flip side, when I invoice the client for this item, I'll be using the 41,900 furniture revenue account. So all I need to do is classify the item on the item window using a sales category, and I know Design Manager will handle all the accounting for me. Now, if I'm not using sales categories, I still need to process the activity into a series of counts. So if I'm not using sales categories, Design Manager would then go to your company information and settings and use your default sales and cost of goods sold accounts. Again, that's simplifying the system to a great degree. You have a lot of power and flexibility in how you can determine those accounts. So be sure to check out our sales category webinar, as I just showed you on our YouTube channel at Design Manager Inc. Okay, now let's take a look at that income statement. Two more points. I discussed the concept of budgets, and for those of you who don't know, in the professional platform, your income statement accounts can have budgets associated with them. So let's take a look at office supplies as an example. Oops. And we can see I can create an entire budget for a particular fiscal year. And I can have Design Manager, I can manually input the budget for each month, or I could take a distribution, say salaries may be X amount, and then Design Manager will spread them to each month for me. Now, that can only be done on income statement accounts because income statement accounts clear themselves out every year. You can't budget a balance sheet account. How could you budget what accounts receivable would be, or how could you budget what your cash may be in one of your assets? But you can set budgets on your income statement accounts and then run one of the income statement format versions that have the budgets for you. Again, a very handy feature if you'd like to take that level of sophistication when crafting your income statement. And finally, you can even run an income statement on a departmentalized basis. Again, I shouldn't have closed my account glossary. Just like you can put a budget on an income statement account, you can also have a department associated with them. So if your design firm has a residential division, a commercial division, or perhaps you have an in-house workshop or a showroom, you can departmentalize your accounts and then run your income statement based on a particular department as well. Okay, now let's take a look at our income statement. And just like we have on our balance sheet, there's a layout for our income statement as well, where we can drag and drop our accounts into the order. We can create our own layouts, groups, subtitles, etc. And here we go. So if our balance sheet showed our assets, liabilities, and equity, our income statement is going to show our sales or revenue, cost of goods sold, and operating expenses. And we can see here's all of our revenue accounts with a non-zero balance, the current account balance as of the period selected. And often I'm asked, well, what do the percentages represent next to the account? Well, in traditional GAAP accounting, those percentages are always based upon a percentage of the total sales. So notice our total sales of 142 and change has a percentage of 100. But if we look at our installation, we can see If we take handy calculator here, divide our 1708.20 by the total sales, and multiply it by 100, we get 1.196, which when rounded gets our 1.2%. So those percentages are always based upon the value against the total sales, even for our cost of goods sold and operating expense accounts as well. So after reviewing our sales, which is total at the bottom, we then have our cost of goods sold. This is the value of the products and services that we bought from vendors and resold to our clients. The difference between the total sales and the total cost of goods sold is known as your gross profit. Then we come to our operating expenses, those business-related expenses that are needed to keep our company running smoothly. And we'll see all of them listed with the total operating expenses. Then we take the gross profit less our operating expenses, and that's our total net income or income from operations. So gross profit is revenue less cost of goods sold, while net income or total income from operations is the gross profit less any operating expenses. And now let's remember our number of our total income of $37,313.38. Because recall, back on our balance sheet, we saw current year income. And if we look on our current year income in our equity area on the balance sheet, it matches the total income from operations on our income statement precisely. That net income should always match on both of the reports. So while our balance sheet describes the overall value or fiscal health of the company, our income statement is showing is taking all of our sales, reducing it by the cost of the products and services that we sold, also removing any of the expenses we need to run our company, and providing us with our total income for that period. Now you may say, well, that's great. I needed to print 2 reports to see all of my account information. Well, we have our assets, liabilities, and equity on our balance sheet, and our revenue, cost of goods sold, and expenses on our income statement, but we can see the account balances for all of our accounts on a report or document known as the trial balance, which again, I've added to my favorites. Another document that you'd often be asked for by your accounting professional at the end of your fiscal year for tax time. And if we run that report, very simple. In account number order, starting with our assets, we're going to see each account with its current balance. And you may say, well, I see debits and credits. Why is one a debit? Why is one a credit? Well, very simply, accounts that have debit balances naturally include our assets, our cost of goods sold, and our liabilities. Those 3 types of accounts naturally maintain debit balances. So if you see a credit balance in one of those types of accounts, that means the account is a negative value. Conversely, the 3 other types of accounts maintain natural credit balances. So we can see that liabilities and equity and revenue accounts all naturally maintain credit balances. Doesn't mean it's wrong, doesn't mean it's improper, it's just naturally stored into credit. Because our trial balance, by accounting necessity, our debits and credits must always equal. If they don't, which is nearly impossible in Design Manager, you're going to have a bit of an issue. So the trial balance summates the information in a much more linear, standard way than the balance sheet and income statement. And again, a very classic document that your accounting professional will often ask for. Trial balance. Okay. Lastly, our fourth of our financial documents today is known as the cash flow statement. And what the cash flow statement does, again, another classic accounting document, it really translates net income that we just saw in our income statement into a cash basis, or it translates the various activities that occur in an accrual system to reflect an overall increase or decrease in cash over time. Let's take a look at that report. The cash flow statement always asks you for a starting and ending period, and we're going to be tracking the changes in account balances within that time frame to again give us an overall change in cash over that time frame. And let's look at all of 2017 for a good sample size in our exercise. And we'll go ahead and print the cash flow statement. Now, I've been doing this for a few years now. I've got a very solid understanding of the cash flow statement, but in my expertise, I find it to be one of the more difficult ones for people to immediately review and understand what all of these different numbers and descriptions are indicating towards us. So let's walk through it together. And it really does tie in a lot of the concepts we've already been discussing when looking at the balance sheet and income statement. Let's make this guy a bit bigger for our review. Perfect. Okay, so we can see the period for which we're reviewing, and we're going to be beginning with the net income in that period. And we can see, there's our familiar 37, 313, 38 that we did see on both our balance sheet and income statement for all of 2017. Now we're going to be reviewing activity that affects that net income in a variety of different ways. First, we're going to review activities that change the working capital. And let's go through each one. First, we have accounts receivable. Now, the parentheses indicate a negative value here. This actually means that my accounts receivable has increased from January of 07 to December of 07. And this actually translates into a decrease in cash flow. It means that we've gone out, purchased goods and services from our vendor, invoiced our client for those. So we've laid out presumably the funds to get them from our vendor, but have not yet been reimbursed for our client for that. So an increase in accounts receivable means that indicates we've been spending funds and have not yet been reimbursed. And that makes sense that may be detrimental to cash flow. Similarly, work in process. Again, this is the negative value. My work in process actually increased from January through December, but this also indicates a reduction in cash flow. I am purchasing goods and services, but have not yet resold them to the client. So I'm spending money with no funds coming in, another reduction in cash flow. Vendor deposits has also increased in that time frame. So now I'm sending out funds to our vendor. I'm either giving them cash, or I'm applying vendor deposits on my credit card liability account. Either way, I'm reducing funds. I'm sending vendors checks, so that cash flows out of my immediate available pool. So that's another reduction in cash flow. So sending out vendor deposits reduces cash flow. Accounts payable. Now here's a positive value. Well, my accounts payable has actually increased by this full $53,871. These are the bills that I've recorded, which matches our aged accounts payable and balance sheet precisely, of course. I've recorded these bills and have not yet paid the vendor for them. So that may sound great. I've gotten the bills and my cash flow is up, but I haven't paid the vendor. That's fantastic for cash flow because I'm getting goods and services. I'm simply not paying for them. I'm recording them coming in, but I've not yet paid the various vendors for those goods and services. So that might get me into trouble down the road with those vendors, but it's a fantastic way to look at cash flow by simply not paying the various individuals or companies. Client deposits has increased over that time frame. Now that's fantastic for cash flow. Clients are giving me funds that I can presumably use to purchase other goods and services, but I'm receiving funds in. So as client deposits increase, obviously cash flow would increase as well. My sales tax has a positive value. That means it's increased from January to December. So I've been invoicing clients at a greater rate than I've been repaying or paying my various tax authorities. So that means presumably that the client's going to give me funds for the sales tax on their invoice. And if I don't go ahead and in turn remit that to the various tax authorities, that also would be advantageous from a cash flow basis. So then we take our starting net income, reduce it by our AR, our work in process, our vendor deposits, and increase it by our accounts payable, client deposits, and sales tax. And trust me on this, on the math, that comes to a net cash from operating activities of $40,563.55. Then we need to look at quote unquote cash flow from investing activities. And I have two examples here. Our undeposited funds account has increased from January to December by the tune of $30,000 and change. Now this means undeposited funds are checks or cash that I have received from the client that I have not yet truly processed into one of my checking or savings accounts. So in the cash flow conception, that's not in the available pool. It may be quite soon, but I can't count on it in my cash flow. It's not in my available checking or operating accounts. So that's detrimental to cash flow. So conversely is the purchasing of equipment. So my equipment asset account, as we saw in our balance sheet, has increased by 25, 45, 15 since January to December. So that's taking capital or funds away, cash away, to reallocate that asset to tangible equipment. It may be very necessary as we need those new printers or new computers or what have you for the company to be working efficiently, but it is reducing cash. It's a negative on our cash flow. So then we sum those two up for $41,946.40. Then finally, we have cash flows from financing activities, depreciation, those types of things. And I have a few examples here. American Express, my credit card balance. Well, that's fantastic for cash flow. I'm simply swiping my Amex, getting goods and services sent to me, but I haven't yet repaid American Express for those goods and services. Basically, I'm using their funds, not my own. Great for cash flow. Common stock indicates that funds have come in from an outside source. The principal or principals have purchased stock into the company, so these funds came in from elsewhere. That's fantastic for cash flow as well. So both of those are positives. And then we take our net income, reduce it by all of our operating activities, our cash flow from investing activities, increase our financing activities, and we come with a net increase of $18,787.30. And if we look at our balance sheet of our starting cash accounts and our ending cash accounts in December, that amount matches exactly. So you truly can take net income and convert it into a conceptual increase or decrease in cash flow. Now, the caveat there, of course, as I said at the beginning of the discussion, using cash flow as an indicator of the company's true health is dangerous. You can see, well, my accounts payable that's quite a bit of money that I owe to various vendors. That has, if I maintain that type of accounts payable for quite some time, that could have a negative marker on my company for trying to get new capital in, or a line of credit, or those types of things, or being evaluated for a future sale. If I'm not paying my sales tax to my tax authorities, that of course could be an extremely difficult or undesirable result. If I get audited by my tax authorities, I don't want that to occur as well. Racking up large credit card bills or credit card balances may not generally be considered a advantageous way to be running your business. Again, bad markers on your credit, those types of things. So even though my cash flow has been great, there are markers within our accounting activities themselves that may not be advantageous. Just because I have tons and tons of cash coming in, if I'm not paying my vendors or running my company efficiently and successfully, and monitoring all of my bills and those types of things, that could become quite a different situation. So again, that's why the accrual method of accounting is the recommended method of running your company. Monitoring cash flow is fantastic, but you really want to monitor your income statement for your net income, and then see the health of your company with the balance sheet. Okay. That brings us to our end of our discussion today. So I tried to go through the income statement, balance sheet, and trial balance, 3 critical pieces of accounting documents that your accounting professional will certainly want to see at the end of the year, along with the cash flow report. Reviewing and understanding each of these for yourself is critical. So I tried to discuss the use of each, the importance of each, to give you a better understanding so you can print and review these on your own in the future. So when you do for your accounting professional, the numbers make sense to you and you have a greater understanding. And with that, I thank you all for joining today's discussion. I hope you attend another of our free webinars in the near future, and take care. Have a great day.